Hello and welcome to an economic and market update. My name is Alex Brandreth. I'm the Chief Investment Officer at Luna Investment Management. This is the first that we've done, so we're just going to go through and give you an update on a number of different topics. First area that we'll look at is the UK economy and give you an update on what's been happening on the UK economy. Clearly, it's been a very volatile time in 2020. Yes, it's important to understand what's happened, but it's also important to understand where we're going. And we're going through a very crucial period for the UK economy, so we'll go through that as well. As well as looking at the UK economy, it's also just as important to understand what's going on globally. Stock markets nowadays are impacted by global events just as much as they are on UK events. So it's important to understand what's going on with the global economy as well. There are a number of risks that are being well reported in the press, but with risk also come opportunities, and we'll be exploring what these opportunities could be for investment purposes. There's been a tremendous amount of policy response, both by a fiscal perspective and monetary. So we'll go through the policy response and the consequences that has on markets as well. We will be touching on the investment markets, so we'll go through how safe haven assets have performed, and also how global equity markets have performed so far in 2020. We'll then finish up with some conclusions and some final closing remarks. So, wow, I mean, I think this chart speaks for itself. This is quarterly UK GDP growth going all the way back to 1955. And it's quite astonishing at the end of that chart and what's happened in the second quarter of 2020. We've seen an economic contraction that we have never seen before. It's broken all records. The UK economy shrank by 20% on a quarterly basis in Q2. The UK economy also shrank in Q1. So 2 negative quarters of economic growth mean a technical economic recession, which is also going to be one of the sharpest recessions that we've seen. Now, the consequences, the reason for this has been driven fundamentally by lockdown and the stopping of goods and exports and individuals going to offices, etc., which has had a significant impact on the UK economy. However, since this data was produced, the economy has moved forward. We haven't had the Q3 statistics yet, but it does look like the economy is starting to rebound. We've seen July UK GDP readings already through, which suggests the economy is bouncing back. The July reading came up through as a positive of 6.6% on a monthly basis. We still haven't had August data, but August data is likely to be stronger with schemes like the Eat Out to Help Out scheme as well. Now, one of the most common questions that we're asked is what has been the shape of the recovery and what's it going to look like? And this data here is from the Bank of England. They put these projection fan charts together. The fan charts suggest the potential projections that could come through for economic growth. The darker green line to the right-hand side of this graph highlights the most probable situation, whereas the lighter green line shaded areas on the outside suggest they're less likely to occur. As you can see from this, initially the expectation from the Bank of England, and this data was done back in August, so it was before the recent pickup in coronavirus cases that you've seen more recently. But that is definitely suggesting that the initial bounce back of the economy is going to be more V-shaped. However, there is clearly some risks to this. As we said, the coronavirus is starting to pick up in terms of number of cases and hospital admissions. So that's going to potentially have a big impact if the UK had to go through another lockdown. As you saw in the earlier charts, the impact of lockdown was significant in the second quarter. And if you saw another lockdown, then you'd expect to see a significant impact on the UK economy. The big questions surrounding that will be how long would the lockdown last? Would it be as long as last time? Or would the government look to have a shorter lockdown period of, say, 2 weeks, which has been discussed a few times? We don't know, obviously, at the moment, where we sit here today, what's going to be the case. It depends on cases and it depends on protecting the nation. The government is on a tightrope at the moment. On the one side, they're looking to protect the people that live in the country as much as possible, but equally, they're trying not to kill off the economy because you've now seen the impact that the lockdown has had onto the UK economy. So it's a very delicate balance that the government are trying to have. As well as this, we've clearly got a big 3 months with regard to trade negotiations with Brexit. And any trade negotiations that come through or don't come through could potentially have a big impact on the UK economy as well. So there are definitely risks over the next few months to these projections that the Bank of England have come through. If in their central case, the UK economy does bounce back and COVID rates start to diminish and there's a favourable agreement to Brexit, you can see that they're forecasting that the UK economy will be at the same size that it was pre-coronavirus at the end of 2021. So it's going to be kind of a lost year or two in terms of economic growth and on a road back to recovery in terms of what the Bank of England are projecting. So how does the UK compare versus other global markets? So coming into this, the UK growth in 2019 was 1.4%. That's slightly below trend. The UK economy grows on an annual rate of normally around 2%. But you can see how big an impact 2020 has been in terms of the overall annual expectation. And this information is from the IMF. It was done back in June. And they're expecting that the UK economy would contract by just over 10%, which is slightly better than other European counterparts. You can see France at -12 and Spain and Italy at similar levels. However, Germany has clearly fared through this crisis better with how they've handled the crisis, and that's had it's still been a negative impact, but it's not been as negative in terms of the economic contraction that you've seen in Germany. The US, as the global superpower and one of the biggest nations in the world, is clearly very important for global economic growth, and it has a big impact on the FTSE 100 as well. And you can see there that the impact's been less on the US. What I would look to as well is what is the expectations for 2021, and you can see across the board there, every single country is expecting extremely strong projected growth going into next year. So you are going to see, yes, 2020 has been poor, but 2021 is a significant bounce back year. What I find really interesting in this table, and this data, as I mentioned, is from the IMF, and there's often a lot of questions about data that comes out of China, but those shouldn't be in place here because this data is from the IMF. But you can see that in 2020, despite China being the first nation that started with the coronavirus in December last year, being significantly impacted, the way that they've handled the crisis has been very strong, and they're not expecting a negative year for 2020, which is remarkable really, as one of the second biggest nations in the world and one of the fastest growing nations in the world. But that is obviously below trend for China. Chinese growth is expected and they target it every year, and that current rate is 6.5%. And you can see that the projections of 2021 are that growth bounces back quite strongly. Now, that's just economic growth. It's also important to see what's going on with the employment market as well. Now, this data is up to date. Unemployment does tend to be a lagging indicator, a lagging economic indicator. UK unemployment is currently at 4.1%. That has been held lower as we've gone through 2020 because of the furlough scheme. The furlough scheme is coming to an end at the end of October. Currently, the UK government have spent 39 billion in keeping the furlough scheme going. However, it hasn't been able to protect everyone. You have seen 690,000 job losses between March and August this year. So we are going through a period where unemployment is expected to pick up within the UK. The UK have recently announced, and the Chancellor announced it recently, the new job support scheme, which is going to last for another 6 months, which is only going to be allowable if individuals come back at least on a part-time basis and work at least a third of their normal hours. And for that, the government are going to be paying 70% of normal salaries for that 6-month period. Now, the furlough scheme has been tremendously popular and has helped support the UK economy very well, as of the other schemes that have been announced by the government. There's currently 3 million workers that are on that scheme, though, which is about 12% of the workforce. Now, Not everyone will be moving to this job support scheme, and you are expected to see more redundancies. As well as that, companies will be coming under pressure with any potential second wave that comes through as well. So it is expected that unemployment is going to pick up from here. And the Bank of England have highlighted it again here and what their central case scenario is, which is that unemployment peaks towards the end of the year at just around 7 to 8%. So 3% higher from where we are today. Now, inflation within the UK, this is CPI. You can see this is a very long chart, long dated chart. It goes all the way back to 1989, and it's updated to date. The Bank of England have a 2% target for inflation, and inflation has been running recently below that trend. And in fact, on a monthly basis, it's just above zero. We mentioned that how successful the Eat Out to Help Out scheme will be in terms of getting people out and supporting the economy, but it has had a deflationary impact on the UK economy because the cost of goods and services have actually been going down. As well as that, you've seen falls in airplane and clothing as well to try and stimulate and get people buying. You have seen costs coming down, which again is a deflationary impact that's coming through. The VAT cut that was announced for the hospitality sector is another deflationary force as well. So there's definitely some deflationary pressures that have come through from weaker demand. Longer term, it's expected, and I'd expect that central banks will be less trying to fight inflationary impacts within their economy. We've been running below trend for some time. The Federal Reserve have come out and said they'd be happy for inflation to run higher over the time. And I suppose if you look at where we are from a government debt perspective, one of the best ways to sort the debt crisis is one, economic growth, but also inflation in the system, because it's going to erode the overall nominal value of that debt. Where are we with regard to interest rates? This again is a long dated chart, and it goes all the way back to the 1980s to show interest rates in the UK used to be at 15%. It's been a completely different situation for the last 10 years or so, when interest rates have absolutely flatlined. If you look from since the financial crisis, they've been at 0.5%. They were cut after the referendum and the Brexit vote in 2016 to a 0.25. Economic growth rebounded slightly, and we saw some slight increases. But as soon as COVID hit, interest rates in the UK were hit to a 325-year low of 0.1%. As well as that, as well as this interest rates being cut, you've seen stimulus in other measures as well. You've seen stimulus in the form of quantitative easing, which has been reintroduced as quickly and significant in size that we've ever seen before. Now, where do we go from here? Now, if there is a second wave, or we need to try and support the economy, one of the regular ways of doing that is by cutting interest rates. But with interest rates being on the floor, how do you stimulate and how do you try and do that? Now, it has been talked about more recently, if interest rates in the UK were to go negative. Now, that's potentially could happen, but that is a very strange situation to think about. That, if you just think about that for a second, if interest rates went negative, that means that you're paid for borrowing money, which seems a very strange thing to do. So have the central bank fired all their bullets? Well, potentially yes. So that's exactly why the Chancellor and the UK government needs to come out to try and support the economy. Now, they've been doing that, and what's happened as well is you've seen through quantitative easing the purchases of government bonds. Now, this is a long chart, again 10 years, showing the performance that government bonds have delivered over that time period, which is a total return, which includes income and capital growth, of 65%. And it's very rare that government bonds give you an annual return of 5%, which is very significant. One thing that we can potentially say for certain is that the potential to deliver those returns going forward is minimised, because the current 10-year UK gilt yield is at 0.2%. So it's going to be very difficult to deliver a 5% annualised return when the only income you're receiving is 0.2%. Interest rates going negative could be a support to that, but it's not going to push capital growth too far. So with that in mind, other investors have been looking for other safe haven assets from their portfolios, and gold has been an increasing prevalent part of investors' portfolios. And one of the reasons for that is, yes, the amount of debt that we have has been increasing, and just while we're talking about that, UK debt has passed 100% to GDP for the first time in 50 years, and that was in May, and the current schemes that have been introduced by the government will only be adding to this debt burden. So that has made investors slightly nervous about holding government debt. On top of that, the return that you're going to get going forward is likely to be minimised. So I mentioned the income is expected to be 0.2%. So after inflation, that's it's a negative return. So investors are looking for other traditional safe havens like gold. So gold, that you've not seen an increase of supply. We aren't mining more gold because of the events of the recent past. But demand is definitely increasing. Demand is increasing because investors like ourselves are looking for traditional safe haven assets that can protect portfolios and maintain diversification. So gold is an asset which looks attractive to us going forward. We don't think we will lose a lot of money in government bonds, but we just don't see being able to make significant returns going forward because of A, the income, and B, the fact that interest rates are going to stay low for a long period of time. Where are we with equity markets? So this chart just goes back to the beginning of 2020. It shows 4 of the major equity markets. So we've got the S&P in the dark blue, the FTSE 100 in the light yellowy colour, the Nikkei 225, the Japanese stock market in grey, and then the Euro Stoxx 50, the European stock market in blue. Although this is a very short time period and it's only year to date, the trends that this graph show have been prevalent now for a number of years. And that is that the US and technology has been leading the way, and the UK has lagged. The UK has lagged for a number of years, one, because of Brexit, and more recently, because you're just not seeing the earnings growth coming through from UK businesses that you're seeing from the technology-orientated businesses. Technology businesses, we'll get to in a second, have performed phenomenally well for the US, which has been one of the principal drivers. So let's just take a few conclusions then. Economic growth in 2020 has collapsed. However, we are expecting, and projections from Bank of England and other central banks, as well as bodies like the IMF, are suggesting a strong rebound in global growth in 2021. Unemployment is expected to pick up by the Bank of England, but remember that unemployment is a lagging economic indicator. UK interest rates at an all-time low level for 325 years. How can the central bank look to support the economy if we saw a second wave? They could potentially go negative, but that is a very weird world that we would be going into. Holding cash, we talked about the impact of government bonds on our outlook there, but it's just as important to think about that for cash as well. Cash at the moment is yielding you very low. National Savings and Investments recently have also announced that they're cutting their rates on cash bonds as well. So in real terms, you're actually losing value every year from holding cash, and that can have a significant impact over time as it's compounded. Other safe haven assets have performed well. We've touched on the performance of government bond. Gold is close to an all-time high. It has dipped just below the 2000 level in recent weeks. The US equity market has been the strongest market in 2020, but has been over the last few years, and that's been driven fundamentally by the technology sector. Thank you for listening today. We obviously can't have time for questions, but I just want to say thank you for listening. We are looking at new ways to deliver these messages and provide you updates on what's going on with the economy and markets on a regular basis. And I look forward to speaking to you again soon. All the best. Bye now.